Well, guys, I just found out some information about QYLD and RYLD that is pretty upsetting. Now, to clarify, this is not the end of the world. I don't know what my puppy's doing right now, but for me in particular, this does change everything about how I'm going to invest moving forward. I also imagine that for any investor that invests in QYLD or RYLD or technically any covered call income ETF, you're probably going to want to listen to this, and this may change your mind about some things in the future as well. Now, I don't want to waste anyone's time, so I'm going to get right to the point. As soon as you guys smash the like button down below and subscribe to the channel. My name is Matthew Muniz. I do weekly content on anything finance related. I have a puppy named Pupila, a beautiful daughter, and a beautiful wife, and I like helping people make their money go further. So basically, my friends and family, we all just received our 1099 divs from our brokerages. They're a bit surprising. They go against what we were planning on and what we thought because of Global X's website. On the 1099 div, it clearly states that all distributions from RYLD and QYLD are 100% ordinary income. They are not return of capital. Now, if you're like me and you invested in NUSI as well, you did get 100% return of capital or non-dividend distributions for NUSI. But QYLD and RYLD, we gotta pay taxes on this now. All of 2021, ordinary dividends. That's a significant tax that I don't think most people were expecting. So just a quick breakdown of the differences between return of capital and ordinary dividends. Well, with ordinary dividends, it's just like ordinary income. So you have a certain tax bracket, depending upon how much money you make, and however much money you have above that amount, that's getting taxed at that amount. So if we look at the 2021 federal tax brackets, if you make between $86,000 and $164,000, any ordinary dividends that you have that brings you between that is going to be taxed at the 24% rate. Anything less than that would be 22%, less than the next bracket would be 12%. So if you're making less money or you're not working at all, this probably isn't that big of a deal. However, if you are like me and you have a full-time job, you probably don't want to pay more taxes than you have to. I already maxed out my 401k to lower my tax bracket and lower my yearly income, so I definitely don't want to be paying extra taxes. One of my strategies and reasons for investing in these covered call ETFs was because I thought that the majority of it was going to be return of capital. So that brings up the next part. What is return of capital? So return of capital is when you receive back a portion of your original investment and it lowers the cost basis of that asset that you had purchased. So you actually don't pay any taxes, you're delaying them until you sell the asset. So when you're collecting these monthly distributions and it's return of capital, your cost basis continues to go down, but you're not going to pay taxes until you sell that. If you're just collecting the money, that's all return of capital and delayed taxing. Now, as I said before, according to the Global X ETF website, almost 100% of the monthly distributions are supposed to be return of capital, but it's completely wrong. Now, if you look around, you're going to see lots of answers on what's going on here. If you go on Reddit, you're going to see people that swear that the 1099 divs are wrong. You're going to get an updated 1099 div, and it's all going to be sunshine and daisies. Maybe they're right, but I don't think so. I called Global X and talked to one of their customer service reps just to verify the information, and the rep from Global X specifically said that all distributions are 100% ordinary dividends. They also said that the information that is provided on their website, on the supplemental tax information, is just an estimate. And they advise that you do not make investment decisions based upon the information on their website. That is what they said word for word, which I respect that. However, it's a little weird to me that they can have such precise information to the hundredth of a decimal place for their percent of return of capital, and then it just be 100% wrong. That doesn't make any sense to me, but neither here nor there. The point is we got to pay taxes, so it is what it is. So Global X also said that they don't actually know how the distributions are going to be taxed until the end of the year when it comes time for them to reconcile all their information and they send it to the brokerages. So my father actually reached out to his brokerage, Fidelity, and asked them if they had the documentation or information from Global X that showed the breakdown of how these distributions were, and of course nobody could provide anything. So we didn't get anywhere with that. Global X did say they would call me back and provide more information, but nobody called me back. So it's been a few days. So basically, if you invested in QYLD and RYLD, you've got a big tax bill coming. Now, that being said, if you stick around for the rest of the video, I'm going to tell you how this affects me, how my strategy is now going to change, and also how this affects the infinite money glitch, which is investing in QYLD or RYLD or NUSI on margin, because it changes everything. So my strategy was to build a nest egg using dollar cost averaging techniques and dividend reinvestment. And I was going to do this for the next 10 years. And then in 10 years, use the passive income to maybe pay for vacations or do whatever it is that I want to do with my family. However, due to the fact that I now know that I'm going to have to pay taxes on a yearly basis on these distributions, I don't want to invest in them anymore. I don't want to grow that nest egg. So whereas before I was doing 50% growth and 50% dividend ETFs, around half in covered call options and the other half in SCHD and SPHD, now I'm going to do around 75% in growth and 25% in dividend ETFs, except I'm going to put a lot more weight into SPHD and SCHD. I'm not going to add any more money into these covered call ETFs because the amount of the distribution is too high and it's going to affect me on a yearly basis that I don't want to deal with. SPHD and SCHD are going to be a lot slower growing in terms of their dividend, but they're still going to also have capital appreciation, which I won't have to pay taxes on until I sell the assets. Now, another thing I was doing, and I know a lot of people do this, especially on Reddit, is investing in QYLD on margin. Now, you could still do this. If you can generate a 12% yield with QYLD and invest in margin and only have to pay 2.5% interest on Robinhood, well, it seems like a no-brainer. You're making a 9.5% profit. Except now, since it's not return of capital, or at least we don't know when it's going to be return of capital, you have to factor in taxes as well. So you're going to have to pay income tax, which is going to take away some of your profits. You're still going to be in the profit, but not as much, and you still have risk. So you have to keep that in mind. If you're investing in NUSI, which has some downside protection, from a massive crash, but you have a lower yield. So you have the lower yield, more protection, but you still pay margin interest and you still pay taxes. So in my eyes, it's not quite as strong of an option when it comes to a strategy for growing your money. Now, personally, I've paid off almost all of my margin and I'm still continuing to work it down. So a big reason for that is margin interest rates can change at any time. Now, the Feds are going to be raising the rates for borrowing money soon. And with that, I believe that margin interest rates are going to go up as well. So if Robinhood's margin interest rate goes from 2.5% to 5%, and we have to pay taxes, you're really losing a ton of yield or a ton of profit that you would have been making. So just something to keep in mind. We don't know for sure what's going to happen. We also don't know if 2022 is going to be 100% return of capital. So really, it's all about managing risk and doing what's best for you and your family. Now, I'm not a financial advisor, so this video isn't meant to be financial advice. It's just meant to get you thinking. Do some of your own research, make your own decisions, and try to set yourself up for success in the future. Now, I want to know in the comments below, you tell me, what are your thoughts now on QYLD and RYLD? If you have to pay taxes now on a yearly basis, are you going to keep investing in it? I told you my strategy. I think I'm pretty much done putting any extra money in it, but I'm curious what you guys think. I hope to catch you guys in the next video. Take care.